everyone, it's Matt here from the Forex Coach. Today we're looking at a very important topic, probably the most important topic that I will talk about, and that is the psychology and risk management when it comes to trading. So I'd like to stress this is the fundamental reason why most traders, so in retail traders they say something around 90%, I don't know the actual figure, but 90% of retail traders fail to make money and actually lose money. And this is the psychological aspect of trading that a lot of people don't think about when they get into it, and that actually is the most important thing to take into account. So what we're going to look at is the psychology of trading, why it's important, mistakes that people make, typical retail traders make, mistakes, how to avoid the mistakes, and how to enjoy trading. So, first topic then is the psychology and risk management. So, just imagine this scenario. You're employed, so this is sort of 2016 data, I believe. If you look at the chart there, we've got an average male in the UK, salary of around £30,258. So, average male. Your boss gives you a pay rise of 5%, which is an amazing pay rise. So an extra £1,500 per year. Now the take-home pay after tax goes from just under £2,000 to £1,988 to £2,074 with an £86 per month extra in your pocket. So you're employed, you've been in this job for a long time, you're on a salary, your boss, you go in for a meeting, you have your review, your annual review, he goes, do you know what, you're doing really well, we're going to give you a pay rise, okay? In that scenario, this particular person would go home, they'd be really chuffed, they'd tell their wife, they'd tell their, the family, the parents, etc., etc., and they would be really pleased with it, maybe have a bottle of wine to celebrate and be really happy with that extra £86 per month. So just think about that figure for a moment. Just think about £86 per month, and that's what we're talking about here. So the same person, so this same particular person is employed and he thinks, I would like to get into trading, I'd like to earn a bit of extra money, I'm going to set up a trading account. I've seen people do it, I've seen it advertised online, I think that's something that would be useful for me, something I could do. So he opens up a broker's account. He's got £3,000 capital to invest out of his own, savings. Now, a good trader can average 5 to 10% account growth per month, and that is trading at 1% max risk per trade. Okay, so let's ignore the 10%. Let's be really realistic here and say they're a good trader or they're following a good signal, and they're making 5% a month. So we're taking the lower figure. So if this particular trader can trade at 5% per month over the course of 12 months, their account will grow as follows. So at end of month 1, all the way through, so it goes up £4,000 after 6 months, and then by the end of 12 months, £5,387. Okay, so this is realistic figures at the moment. So in 12 months, this trader could have made £2,387 return. So if that was a pay rise on his salary, we'd be looking at around 8% pay rise. Okay, so a realistic view of trading, you're looking at equivalent pay rises. So he would have gone into that meeting with his boss, and the boss wouldn't have gone, no, it's a 5% amazing pay rise. It's even better, it's 8%, which is unrealistic. Everyone knows you would very rarely get an 8% pay rise unless you've had a promotion. So, okay, let's say it's equivalent to a promotion then. So they've almost had a promotion at work. So think how good that would feel. It's an extra £198 tax-free per month. Now, when you break it down, it's actually under £10 per day. So this particular trader, to achieve this, the equivalent of an 8% pay rise, is only looking to make an extra £10 per day on a 3,000 count. So these are all realistic figures. So over a few trades, you should be looking at profit £3 to £8 per trade. So you might have the odd one here, £3, one that's £5. He might get a £10 win. He might even get a £15 win. He'll then have a £5 loss. He might have a a £6 loss. But overall, he's making on average £10 per day based on these figures, and that is the growth that he would give. And these are realistic figures. So based on this person's account size, this trader would be starting with a position size between 50p and 80p per pip. Now, if you're new to trading and you're unsure about working out your pip size in your trade or position size, then go onto our website and have a look at this pip calculator that we've got, or this trade size calculator. And basically, you've got some different currencies there. You can change them. You put in your account size, put in an average stop loss. There's pre-populated ones in there, and it will generate for you what position size you should be trading at. Okay, so looking at this particular trader, they're employed, they're on their £30,000 a year, and they've just started a brokerage account. They've got £3,000 in it. They're looking to make £10,000 a day because they want the extra money at the end of the year, the 2,000 and whatever it worked out to be, and they're trading at 50 to 80p per pip. Okay. So, if that particular trader wanted to trade full time, they would need an account of £40,000. Okay, and the reason is to make £2,000 per month, 5% average return per month. Your account size needs to be £40,000. So, based on those figures, which are our realistic figures, okay, it's going to take the average person just over 5 years to get to the point where they can go, I am ready to leave my job and trade full time. Unless they've got £40,000 that they inherit, or £40,000 that they can save, or £40,000 of capital elsewhere that they can put straight into an account, which I wouldn't recommend people doing straight away. I would say you need a good couple of years of trading consistently before you can take that sort of risk. But if it was just the average trader, to make that £2,000 a month to be able to trade full time, this is how long it's going to take. However, you might have the average trader that can put £3,000 a month in, £3,000 initial capital in their account, and then an extra £200 a month to their account. Straight away, that then reduces the time to get to the 40,000 to about 3.5 years. Okay, somewhere between the 3 and 4 years. So potentially 3.5 years, if you're this person, you could potentially be a full-time trader. And then in the extreme case, you might have the trader that starts with £3,000, and then they might be able to make a 7% average return and put an extra £200 a month in to their account, and then they could be a full-time trader within 3 years. Okay, so there's different scenarios, and it totally depends. And this is an optimal, an idealistic view, but it's one that is possible. It is possible, and I'd like to stress that. If someone could trade consistently and manage risk correctly and trade sensibly. So, what actually happens? What actually happens in the real world? Well, what happens is the same trader. So he's on the £30,000 a year. He's got the job. He goes, do you know what? I'm going to get into trading, and he wants to start trading. Okay. The trader actually has no idea about position size. He has no idea about account growth, so he hasn't looked at those figures to go, actually, yeah, I will be able to make decent money. It's going to take me quite a few years. But for now, just to make what I would be really pleased with, if it was a pay rise in my job, I can do that straight away. I can do that from tomorrow. He doesn't know any of that. So he thinks £10 a day is a waste of time. He just thinks £10 a day, what am I doing this for? I want to be one of these people driving around in a Bentley. I'm not going to do that £10 per day. And he thinks taking £3 profit on a trade for a winning trade, he thinks that's a waste of time, not even worth it. He thinks £5 for a winning trade is less than he just paid for his lunch. So psychologically, in his head, it just doesn't fit. He's imagining this lifestyle. He's imagining being a full-time trader. He's imagining this Bentley car and what he sees, and he thinks, this is it. This is my chance to get out of my job. But he can't see it making the £10 per day. But the fact is, he actually doesn't think. He doesn't think it through at all. Instinctively, this is what subconsciously is thinking within him. So he automatically trades to make £10 to £20 per trade. So I think he thinks to himself, yeah, if I'm going to do this, I've got £3,000. If I'm going to trade, I want to make 10, 20 quid. No different to if I put a bet on the football the weekend. I want to make 10, 20 quid. So he's a gambler. He's not a trader, okay? So he has a few losers. And quite soon, he thinks, oh, this is harder than it looks. I've actually lost £100. He might have had the odd winner here or there. That gives him a bit of hope. He might have had a couple of days where he won. But he quite easily loses £100. So he thinks to himself, well, I have had a couple of winners. I think I'm getting this. I think I can make back the £100 easily. So he increases his position size, and then he ends up losing another £100. At this point, this trader has gone from trading 1% risk, where he could have lost £30 a trade, which is what he should have been at the 50p to 80p per position, to 4% risk, where he could lose £120 per trade. So if you look at this, we've increased the max risk to 4% per trade, and his losses could go up to £120. Now, look at the pip size that he's now trading. To try and make these £10 or £20, he's then going, oh, I'm going to be trading £2, £3 a pip. So what's happened now? Very shortly, he might have only been trading a few weeks, a few months, even a few days at this point, but he's already used to trading at £2 or £3 per pip. The thought of trading at 50p per pip is a distant memory to this guy. Absolute distant memory. Now he's used, he's been there, he's done it, he's got accustomed to losing that money and kind of a bit resilient to it, that even the thought of trading 50p a pip is a distant memory. Also, if he goes back to 50p a pip, however long is it going to take him to win his £200 back? So the trader's not thinking of compounding interest on an account growth. He's not thinking about growing an account and becoming a successful long-term trader and a full-time trader. All he's thinking about is, I need to win my 200 quid back. He is a gambler, okay? So he is turned into a complete gambler. This goes on and on and on, and the trader just turns into a spiraling hole of bad trading. He just goes in circles, round and around, repeat, repeat, repeat. He doesn't tell people he's losing money. He can't tell his wife or his family, not of his family or his family. He's searching for a solution and maybe paying for new training material and signals that are scams. There's so many scams out there, I can't believe it. Since I started doing this, I've had a little look, and I knew there were scams because when I started trading in the early days, if we go back sort of 7-8 years, I'd done signal services. It was the early days of Facebook back then and stuff, and I'd done signal services and just couldn't believe that people were happy to take your money and just send you a load of rubbish. The same with training material. There's loads out there that sell you this dream, be a full-time trader in a year or 2 years. It's unrealistic. Look at the realistic figures that we've done. So this particular person starts looking for a magic solution that's going to save the day for him. So he tries loads of different things, spends even more money. By this point, he's getting stressed. He has mood swings because his mood's going to change with the market. It's affecting his health. Could be affecting his family and his works, his relationships with his wife, with his girlfriend, with his children potentially. It could be affecting his work, his job, because he's constantly checking his phone, checking his trade, worried about them, etc. He could be losing sleep as he knows overnight he's overexposed to the market, he's in a drawdown, he's stuck in a losing position, he can't think of getting out of it. He trades badly by moving stops too close to the market because he's over leveraged. So he's gone in and he's gone, oh, I can't put the stop up there, 200 pips away. Oh, I'll take the risk, I'm going to put it 50 pips away. And then the trade goes, 10 pips up and he thinks, yeah, that's it, I'm going to move it right down. And what happens? He gets stopped out of what could have been a winning trade. Or he just gets stopped out and loses his money anyway because it's too close. He then falls into this ongoing cycle. He has the odd few small wins, he has big losses, and every time he overexposes himself to the market, potentially blowing up account after account. Now, I know people watching this at this point will be saying, oh, that is me, yeah, I've done it. So many traders have done it, and I've spoken to so many traders and helped so many traders that have done it. It just happens automatically. It's human instinct. So this particular trader is now in a terrible place. He may have been trading a year now and simply just lost money. At his worst, his position sizing on his £3,000 account may have gone up to £5 a pip. So at one point he might have gone, do you know what, 3,000, I've down to my last 1,000, or I'm just going to have to go in at £5 a pip. Just gambling instinct. If you work that out though, he may have traded as high as 10% risk per trade. So that 1% figure that we said is what you should be trading. If he went to £5 per pip, he was putting on 10% risk per trade, which based on our original simulations means he was trying to achieve a 50% return on his account per month. Okay, so based on our original calculations that we said realistic return on your account per month of 5%, based on a 1% position size, he's times that by a magnitude of 10 by going in at £5 a pip. What does that mean? Well, it means that actually he's looking for £50 return per month if you worked it back. So if you actually done the figures for that, based on his £5 a pip, across the year with compounding interest, he was looking to make his £3,000 account grow by £386,000. So an extra £32,186 per month. An extra 32 grand a month, because that's how over leveraged he was. Okay. Now, if you started off with these figures and said, right guys, we're going to get you into trading, you start with a £3,000 account, you put on £5 a pip, you can make 50% return on your investment per month. Within a year, you're going to have £386,000. You're going to have an extra £32,000 a month in your back pocket, average cost of 12 months. You would go, yeah, pull the other one. Scam, absolute load of rubbish, it's impossible. Any rational person would, and that's because it is. Totally unrealistic figures. Impossible figures. No one could achieve these. Okay? Totally unrealistic figures. So why is this person doing it? This person is doing it because they don't realise that this is where they're at and what they're trying to achieve compared to where they should be at. So why does this happen? Well, you've got greed. As humans, we're greedy. We want more, we want it now, we want it tomorrow. We live in a world where things are instant, we can do things instantly. It's human instinct to gamble and take chances. It's within us, some more than others. So some people, and this is the problem with trading, is the type of people that can actually go, do you know what, I've got £3 grand, I'm going to try trading, are the type of people that are automatically have this gambling instinct in it. The cautious people, who would probably be better traders because they wouldn't take the risk, are the ones that wouldn't even try trading in the first place because they wouldn't take that £3 grand and put it in a trading account. They're way too cautious. So straight away, the people that go into trading are probably the worst possible people to trade. It's the same the difference between men and women. Women tend to be better traders than men in a lot of ways because their risk management is far better. Brokers, they really do not help the situation. A lot of them have a minimum position size and it's way too high for your account. So this particular example was a person with a £3,000 account. Probably 50% of traders that start up, maybe more, I've got no idea the percentage, have way less than that. Probably less than £1,000. Now if you're trading a £1,000 account and you use our pip calculator, and there is another video for that on the website, under the basics of Forex. So if you go on the website, click on the tab, the basics of Forex, so it's an online training course and the basic Forex, you'll find the pip calculator. So you'll find that people should be trading as low as like 10p a pip while they're getting started, okay? Especially if they've got this low account size. Poor education, especially regarding risk management. So this should be the fundamental, the first topic that anyone do does or advertises, but they don't. They all advertise pictures of charts and these amazing indicators and drawing these trend lines and supports and resistance, and you get down to here and the market's going to go up to there, and it's an absolute load of rubbish because half the people that are doing it cannot manage their risk. So what a waste of time. People automatically think the most important bit of trading is the entry. Where do I get in? Where's the market going to go? Shall I buy here? Shall I sell here? You know, what MACD shall I use? What momentum indicator? If that crosses, where's my entry point? What indicator am I using? Support and resistance? Again, that's not important. It's not important at all. The entry, I would say, is the least important part of trading. Okay? What is the most important is the position size, the trade management as the trade's taking place, and the exit when you get out. Because the exit takes way more discipline than the entry. The only bit that is important about the entry is being disciplined with your entry and not just taking any entry, having some sort of rules in place. Overexposure to the same market. So people that are new to trading, they think, yeah, I'm going to trade Euro US dollars, I'm going to trade CAD US dollars, I'm going to trade pound dollar, I'm going to trade other dollar related to dollar yen, and they think, yeah, I'm in 6 positions here, but you've got 6 positions that are potentially all dollar related. So you've got to understand the market and how different currencies are almost the same thing in a lot of ways. So if the dollar's strong, it would probably be strong against all the currency pairs, okay? The same with the stock market indices. You could be in lots of different stock market indices, and they're all related to a way, like the indices are related to the dollar, just like the UK 100, the FTSE 100 is related to the pound. If the pound is weaker, the FTSE 100 is stronger. So if oil's weak, then the CAD, Canadian dollar's weak. If there's a risk-off sentiment, then there's flows to safe havens such as the Japanese yen. So if stock markets are going down, the Japanese yen could be going up. The same with gold. So if there's a risk-off sentiment, then the dollar yen could be going up, so could gold be going up, dollar could be coming down, the indices could be coming down, and you find that, hold on a minute, you've got one thing happening in the market, but 5 different markets are all moving in the same direction as a result. So you could go, hold on a minute, I've got 1% per trade, what's going wrong? But you actually haven't, because you're in 6 of the same trades. So effectively, you've got 6% exposure to the market. So you've got to really limit what pairs you trade, try and have a mixed bag. So on our day trading signal, we've got a really good mixed bag of currencies. So we've got probably 3 dollar related currencies. Then we've got Aussie, New Zealand dollar. We've got a couple of other currencies. We've then got a couple of different indices, so European indices, US indices. We've then got a Swissy trade on there, so a Swissy pair. We've then got commodities, we've got oil on there. So we've got a real mixed bag, and we're very careful with how we expose ourselves. So that means that we are not overexposing ourselves to the market. The other big issue is just the gambling, the doubling up to make wins back. Go, oh no, I've lost, £10. If I try and win it back, I'll double up. And then people get into scalping, where they're taking 5 or 6 pips on a trade. Don't become a scalper. You will not be able to day trade properly and be a scalper. There are professional scalpers out there that make money, but they're very experienced at it, and someone coming into doing that would not be able to do it. So you will need to be looking for half decent sized runs. You need to be looking for the 20, 30, 40, 50 to 100 pip runs if you're day trading, intraday trading. So what can new traders do to avoid it? Well, as I've already said, go to the forexcoach.uk, click on the online course, and then you can click on the basics of Forex, and then video 5 is about risk management using the risk calculator, and there is actually a separate tab. You can download the spreadsheet and actually use it for yourself. Make a good habit of risk management from the start. So it's dead easy. If you're new to trading, you're actually very lucky that you've found this, because you can make a really good habit of risk management from the start, okay? You need to use a broker that allows you to trade the correct size. So work out your position sizing using the calculator, then look at a broker and see what their minimum position size is. Some of them, I think IG, their minimum is 50p, so a lot of people won't be able to trade with them. ETX, I think their minimum is 50p. The lowest I do know, FXCM, and that is why we do recommend it for new traders, is that they do allow as low as 7p per pip. Okay, so it's probably one of the lowest you can go. So what do you do if you're watching this video and you think, he's just described to me exactly what I've just gone through? There is me, that's exactly what's happened to me, and I'm in a bad position. There is a solution. You can get out, but it is going to be way more challenging for you because you're already programmed now. You're already pre-programmed. So you have to change your mindset and change your programming. The only way to do that is to do something right and repeat until you reprogram yourself. So what do you need to do that's right? Okay, so there's some solutions. So stop and reset. Say, right, today I'm stopping. Even if you've got trades open now, just close out, get out, cut them short, stop and reset. Forget the money, because the money is actually not important. If you're not trading and not making any money, or trading and losing money, or just trading for a small amount, it's not important. It's the concept of trading, the fact that you can grow compound interest in your account and grow that account, okay, by making steady returns. Now, if you've done that with £50, it doesn't matter, because in 2 years' time you can scale it up. Okay, once you get consistent and confident, you can scale it up. So forget the money for a bit and just say, do you know what? I've blown my money. I've now only got £250 left. I'm just going to do it with £250 and do 7p a pip, or whatever it works out to be. Follow our trading signals. Stop you taking unnecessary risks. If your entries aren't good, your exits aren't good, you don't know how to trade, you haven't got the education you need, then just go follow our signal, okay? And we will manage your trades for you. We've got the market's been monitored, 20 hours a day. Probably a bit less than that, probably more like 18 hours a day. But yeah, at some point or another, we've got our eye on the markets. We know what's going on. We've got steady gains. It's all on the Facebook page. We're putting all closed trades on there, and we're even going through our account. And we're starting off. We've got a £20,000 account. It's now up to about 22,000, I think, and we're going to turn it to £200,000, and we're going to do regular video updates to share how to do it. So you can follow our signal, stop yourself making mistakes, reduce the amount of your trading capital in your trading account. So reduce your pairs, as we've already said, the number of markets that you can trade, and reduce the capital in your trading account. And how will that help? Well, let's say, for example, you've got £1,000 left. Say you had a £10,000 account and you've blown it up and you've got £1,000 left, okay? Now, if you've got £1,000 left, you might say, do you know what? I'm going to put £500 in my bank account and keep £500 in my trading account. Now, I'm still going to trade my trading account as though it's £1,000, but this is going to stop me over leveraging. And the reason being is, if I over leverage, I will get a margin call off my broker. Okay, so basically a broker works on margin, and that's all based on your account size. So this is a really good tool for anyone who's turned into a gambler and can't trust themselves. Okay, now someone who is, gambling is really regulated, but trading isn't, unfortunately. So like, you can't set your broker to have a maximum daily loss, or you can't set your brokerage to say, do you know what, stop taking money, block my card. But with gambling you could. So a betting site has to allow you to be able to block your card, stop yourself paying in. But someone in this scenario, what they can do is just take the money out of their trading account, have a smaller amount in there, but still trade it based on the bigger amount. But they will get margin called if they try and over leverage. Okay, so if they try to open, if you had £1,000 worth of trading capital, but say you only have £500 in your account, and you was meant to be trading, I don't know, 30p a pip. If all of a sudden you tried to trade at £5 a pip, with £5 in your account, it either wouldn't let you because you didn't have the trading margin, or if you opened up a couple of positions, I don't know the exact maths, but you'd be able to play with it and see, it would close your positions down automatically and stop you losing that money. Or your broker would ring you up and say, look, you've got a margin call. You either need to close trades down or you need to increase the trading capital. Okay, so let's look at the next thing then. So what can you do? So you can then use extra support, i.e. we could ask for your trading statements, and then knowing you will have to check, we will be checking these each month, it might stop you doing it. So you join us, you follow our signal, you get support, you can ask me questions and stuff like that, and you may find that you want to send us your trading statements, or you might say, highlight to me that you've had this problem with over leveraging and stuff, and I say, right, okay, every month I'm going to ask for your statements. You send me your statements, and if you're over leveraging and not trading sensibly, you'll get a phone call from me, and we discuss it, and I will try and put you right and help you. Design a system for trading. So if you have a setup, make a rule that you will only take a trade if this happens, i.e. a MACD cross. So this is a good tool because a lot of traders will go, oh yeah, right, what I'm doing is the market's going up and up and up, and then I'm selling. I think it's a sell here. Yeah, so pretend that's a line of support. Market's going up of resistance to the resistance, and I think that's what I'm just going to sell here. Fine, but wait for confirmation. So say to myself, right, this is my sell point. My rule is down here, I've got my indicator. When this MACD crosses, now I'm up here, when this MACD crosses and closes, so say it crosses and closes crossed, then I'm going to sell. And that's what point is. So you're disciplining yourself, you're making rules. Whereas at the moment you might just go, yeah, when I get here I sell. So that effectively what you're doing is you're top and bottom picking, which is a really common mistake, okay? Stop and trade the momentum. When a momentum's going up, it can just keep going and going and going and going and going. In this case, it might go like that, start to turn, but then go up a bit more. So you would never have got your MACD cross. And then it kept going back up and up and up, and it saved you. And then it ends up going up to here. And then it looks like it's going to cross, and then it doesn't. It goes up again, and it ends up having a divergence or something like that. And then finally, it crosses, but it turns out it's 3 days later than when you first thought, and 100 pips higher. So you've just saved yourself all of that 3 days of pain watching that market. You was in drawdown, you eventually got stopped out up here, so that was your stop loss, and then it did come down in the end. So you were right, which often happens. It is going to come down, but not when you think it is. And that's what waiting for the market to come to you is all about. It's such an easy thing to say, but wait for the market, okay? It might have come here and then gone up, and then it might have come over and started to come back down, and then you think to yourself, oh, I've missed out, I was out with the family, so what I'm going to do is I'm going to get in here. It's already moved down, a fair bit, so I'm going to get in here and put my stop loss up here at the high. And then what does it do? It bounces back up and stops you out. Whereas what you could have done is gone, oh, I've missed my entry, the MACD's crossed already. Do you know what? What I'm going to do is wait. If it carries on going, then I've missed out, fair play. But if it bounces back up and comes back to me, near where I could have got in, I'm going to get in. And then you get in, and you end up having a stop loss higher up, and it does come up a bit more to take out the stop loss just above the high, and then it comes down. So be patient. Don't feel like you're missing out. Don't chase the market. And then you need to do these things and just repeat. Okay, it's the only way you're going to reprogram yourself, and it's going to take time, but it is possible to do. I hope that helps. That's the end of the recording. Any questions, obviously send us a message. All our contact details are on the website, so you can reach us there. And happy trading.